Buyer wants to keep the loan for the life of the loan. What does that mean? So if you purchase a house subject to the existing mortgage, and there's 28 years left. Let's say the homeowner has owned the house in the last 2 years. So they bought it 2 years ago. Now they have to purchase it. The house is worth 500. They owe 498,000. For them to sell it the traditional way, they'd have to hire an agent, put it on the market. It's going to cost them $50,000 out of pocket. Oh, and yes, they can do a short sale. We can talk about that later and address that a little bit later on. But now it's going to cost them $50,000 to sell. Okay, let's talk about purchasing your property sub 2, okay, subject to the existing mortgage. Now, before we get started, I want to make sure that you understand that buying sub 2 is a possible solution. It isn't the only solution. So sometimes people will come and they'll get involved in this business and they'll have looked at a bunch of videos on YouTube about trying to understand what purchasing a house subject to the existing mortgage is. And they'll say, I talked to a few agents, I talked to a few sellers, I told them that I'd like to purchase the property by me taking over the mortgage subject to, and nobody was interested. The agents weren't interested. They were rude to me. They called it a scam. The sellers weren't interested. They said they would never do something like that. And yes, that is always a possibility. This is just a possible solution. It is not the only solution. So I think sometimes people look at the strategy behind purchasing a house subject to the existing mortgage, and they assume that just because on the surface it sounds like a great idea, it sounds like it's a win-win for the seller and for the buyer, it sounds like it's a win-win strategy for everybody that's involved, but even though it sounds like a win-win situation, not everybody is going to take advantage of it. That's just the reality of it. Not everybody is going to be interested in it. You could be standing on the corner of a street with a stack of $100 bills, and you could be handing out those $100 bills to every single person that comes by. And you'll hand out a $100 bill, and there'll be one type of person that will walk right by you, just completely ignore you. They'll think you're crazy, and you're handing out real $100 bills on the corner. Then the second type of person will come and you'll hand them a dollar bill, and they'll pause and they'll look at you and they'll start asking you a bunch of questions. Why are you handing out $100 bills? What are you doing? Are you crazy? Why are you here at lunchtime? Why do you have a stack of $100 bills? Where did you get those $100 bills? How many of those $100 bills are? And they just bombard you with questions, and then they just walk away without taking the $100 bill. And then there's a third person that after you're handing out $100 bills, they just see you handing them out. They'll walk right by you, grab the $100 bill, walk right down the street, and no questions asked, and they'll just accept it. Those are the three types of people that you're going to come across. There's a type of person that will absolutely not be open to this, to hearing about what you have to say. And then there's going to be somebody that's going to listen to what you have to say, and they're going to have a bunch of questions, and then they may not participate in it. And then there's going to be some people that you're going to offer this to, and they're going to be like, yeah, hey, sounds good to me, let's do this, it works, right? That's just the way life is. So don't assume that just because you're coming across three different types of people that you're not going to experience the exact same thing when you're making offers or when you're suggesting purchasing a home subject to the existing mortgage to sellers, to agents. They could reject it as well. Okay, now this is not new. This is not new. Purchasing a home subject to the existing mortgage is not new. So for some of you who are young, this may be new to you. This may be the first time that you've ever heard of this strategy, but this strategy has been going on since the 60s and in the 70s, and in the 80s, there was the granddaddy of all subject to, buying homes subject to the existing mortgage. His name was Carlton Sheets, and he did this in the 80s, and he had VHS tapes. Some of you have no idea what a VHS tapes is, and he had cassette tapes that he would sell on TV late night. He would have his infomercials. You could catch them in the evening or on the weekends, early in the morning. I remember watching them, and he would sell he called it a no down payment. 50 days to your first home. You may be able to see it on the screen or not, but he had a no down payment techniques video. He had tapes. Eventually, he transitioned into DVDs, and you Gen Zers may not even know what that is, but he transitioned into DVDs, and then I remember when my parents purchased it, we had the kit. I remember going through the CDs and the DVDs and watching all of this stuff. This is not new, okay? Buying a home subject to an existing mortgage is not a new strategy. It's something that has been going on for decades now. People have been doing this for a long time. It's just that now it's become a little bit more popular because of, YouTube YouTube and TikTok and other influencers that have been teaching people how to do this, as opposed to what the granddaddy used to do, Carlton Sheets, which was he used to spend hundreds of thousands of dollars doing infomercials. Now, another thing, you have to seek your own legal advice. If you are going to be purchasing property subject to the existing mortgage, if you are going to be making offers, if you are going to be wholesaling and assigning these opportunities to other investors, number one, I am not an attorney, and anything that I am saying right now cannot be considered legal advice. You need to consult your own attorney. You need to consult your own mentor to help walk you through this process. Very, very important, okay? Because this is not a traditional strategy to be buying properties with. Now, what is buying a home subject to the existing mortgage, aka sub 2? What is it and what is it not? Well, number one, you're not assuming the mortgage. Okay, this is a very big misconception. People think that when you're purchasing a home subject to the existing mortgage, that you're assuming the existing mortgage. All right, an assumption of a loan is where you go to the borrowers, the seller's current lender, and you essentially apply to be able to just take over the existing terms of their mortgage. You're assuming that existing mortgage. There is no guarantee, number one, that you're going to qualify for that existing mortgage. And then number two, there's no guarantee that they're going to actually give you the exact same terms. They may try to change the terms up on you if you do that, okay? It is not an assumption of a loan. And when you talk to real estate agents, a lot of real estate agents are not familiar with the strategy of buying a house subject to the existing mortgage. And so when you even propose it, they're going to tell you something like, oh, so you want to assume the mortgage, right? They do that all the time. I will tell you, as a broker and as an agent, okay, I've had my real estate license since I was 18, my broker's license since I was 30. And I will tell you that these are not strategies that are taught by our national association. They don't teach us these terms, and so we just naturally, as agents and as brokers, we assume, right? We assume that you are talking about assuming the existing mortgage, and it is not the same thing. You have to be very clear. You're not taking over the loan. That's another thing. Okay, so you're not taking over the loan, you're not assuming the loan, and you want to make sure that you're very clear with your language when you are proposing this kind of strategy to be buying houses. You are making payments on behalf of the seller. There is a very, very big difference. So when you talk to people about purchasing a home subject to the existing mortgage, you're not assuming the mortgage, you're not taking over the payments, you are making payments on behalf of the seller. There needs to be a very clear distinction. I hear a lot of people talking, and they'll say things like, "Oh, so you're going to make the payments. You're taking over the payments." Yes, but no, you're not. You're making the payments on behalf of the seller. Why? Because the mortgage stays in the seller's name. This is very important. On an assumption, you are applying to the existing mortgage lender, and you are trying to transfer that existing loan into your name. With a subject to purchase, the mortgage stays in the seller's name. It doesn't change. The terms don't change. You have to be very clear about that. The responsibility is ultimately still on the seller. All right, now I know some of you who are watching this right now, you're already thinking to yourself, well, what the hell? I mean, you're making payments on behalf of the seller. The mortgage remains in the seller's name, and the responsibility is still on the seller. What type of person would be open to something like this? Why would they even consider something like this? And we're going to go into the pros and cons in a little bit, but the responsibility is still ultimately on the seller, even if the buyer continues making those payments, right? Because the loan still stays in the seller's name. Now, why would a seller want to do something like this? Why would they even consider this? This sounds crazy. Why would I do this? Why would I sell my house to you, keep the mortgage in my name, and then just allow you to make payments on it? It almost doesn't make sense. Well, number one of the main reasons is because there are some people that are just emotionally detached from the house. And when I say emotionally detached from the house, it can mean a variety of different things. They just don't want to live there anymore. They don't care about the house. They don't care about the mortgage. They're just, for whatever reason, they've already detached themselves from the outcome. They've already detached themselves from the house. So emotionally, they've already sailed off into the sunset. Rode off into the sunset? motorcycled off into the sunset. Anyway, all right, the second reason, they might be facing foreclosure. There are some people who are facing foreclosure. They are in default. And so this strategy would actually, be something that they would consider. And we'll go into why in a little bit. They don't have any equity. Again, when you don't have equity in something, right? When I say equity, what we're talking about is the difference between what they owe on the home and the value of the home. So if the home is $500,000 and they owe $498,000, they have no equity. There's $2,000 worth of equity, but it's very, very little. Now, in some rare cases, you will have some people that will actually have negative equity, which means the home is worth $500,000, but now they have a mortgage on it for $510,000. So they actually owe more on the house than the house is worth. That is also known as being upside down, right? That's negative equity. So when they when they have very little equity, when they have negative equity, they are also, again, emotionally detached from the home, usually, and they have less of an attachment to it. The other reason that a seller would go for something like this is because if they really do want to sell, and the seller says, I don't want to have anything to do with the house anymore. I just want to get rid of it. I don't even want to have anything to do with the loan. I just want to sell the house. Well, if you have very little equity, what you have to consider is the fact that the seller will probably have to come to the closing table with money. What that means is they are going to have to pay out of pocket to sell the property to somebody else. Why? Because let's go back to my example. If the house is worth $500,000 and they owe $498,000 and they want to sell a home traditionally and they want to hire a real estate agent, it's estimated that their expenses to sell a house is roughly going to be about 10%. Roughly. Okay, roughly. It could be less, it could be more. Those are rough estimates. 10% of $500,000 is $50,000 that seller would have to pay out of pocket just to be able to close that transaction. Just to be able to sell their home to another buyer, they actually have to dip into their pocket, dip into their savings, dip into their checking account, pull out money, and basically pay the buyer to buy their house, if you think about it, really, right? That's really what's going on. They're paying the buyer to buy their house by having to come out of pocket. And that happens a lot. There are some people that, don't want to do that. And so they just decide, hey, I don't feel like doing that. Why would I have to pay to sell the house to another buyer? It doesn't make any sense. I'm already upside down as it is, right? And so they don't want to pay to close. This happens a lot. And number 5, another reason why they might consider this is because a savvy seller understands that if they have a good interest rate, right? There are some sellers out there who purchased during the pandemic that have interest rates in the 2s, in the 3s, in the 4s, in the 5s. I met someone recently that had an interest rate in the 1s. They had an interest rate in the 1s. And those people know that they have something of value, because you're not going to see those interest rates again. There's probably no way that we might get back into the 5s if we're lucky, but I don't see us ever going back to 4s or under. It's just not going to happen in our lifetime. I don't believe, but prove me wrong. So they understand that they have value in those interest rates, because if you go right now to the bank, you're going to get interest rates in the 6s, 7s. Oh, and by the way, if you're purchasing this as a second home, you're going to have interest rates in the 7s, 8s, maybe even higher. And so they understand that there's value in their interest rate, and they can make it more attractive to other buyers who want to be able to take over that interest rate and take over that payment. What are the risks to the seller? Good. I appreciate the comments. Thank you for taking notes. What are the risks to the seller? Number 1, the due on sale clause. Okay, this is another thing that people like to talk about as a risk, and they should. That is always a possibility. The due on sale clause is always a possibility. Real estate agents love to bring this up. Attorneys like to bring this up too, because it's just a hard reality of buying a home subject to the existing mortgage. A due on sale clause. What that means is that at any given moment, when the property exchanges hands, at any given moment, if there's a change in title, the bank could call the loan due. So, going back to my example, $500,000 home, there's a $498,000 loan against the home. The seller transfers title into somebody else's name. the bank could say, hey, you just transfer title into somebody else's name. We want the full $498,000 right now. That's what a due on sale clause is. Okay, really, they should just call it a due on transfer clause, because that's what that is. But it's called a due on sale clause. Every loan, every mortgage that is created, right, when someone buys a home, there is a due on sale clause in the mortgage. Now, what does that mean? That means that anytime there is a change in title, anytime, the bank could call the loan due. But here's the caveat. That also means that if the seller, and let's not even say the seller, let's say the home owner decides to transfer title from their property, from their personal name, they now want to transfer it into a trust. They now want to transfer it into an LLC. They now want to transfer it into their spouse's name. They now want to transfer the property to their children. They now want to transfer it to their family, right? Anytime there's a transfer, that due on sale clause could be triggered. And so the burden of proof is on the owner's responsibility to show the lender, if they ever do call a due on sale clause, if they ever do call the loan due, the burden of proof is on the seller to be able to prove, wait a minute, I still own the property. All I did was transfer it into a trust. All I did was transfer it to my spouse. All I did was transfer it into an LLC that I own. All I did was transfer it to my children. You can't do the due on sale clause. I'm still the owner, right? So there is a caveat to this, right? And so people have learned this, and there's different ways to protect yourself as a seller who is selling using the subject to the existing mortgage strategy. I'm not going to go into depth on this training. This is more or less surface level stuff. Number two, what is another risk? Buyer stops paying, right? That's just the reality of it. The buyer stops paying. That's a risk, right? We went going back to my original slide when I said, hey, you know what? I just lost my train of thought. You just saw me go completely dumb for a second there. Anyway, buyer stops paying. Okay, if the buyer stops paying, then obviously the seller's still responsible. That's what I wanted to do. The seller is ultimately responsible for the loan. Okay, remember that. Very, very important. The seller is and always still be responsible for the loan. So if the buyer stops making payments, well, now the seller has to step up and they got to start making the payments. That's one of the risks, right? Better that you address these risks now. Better that you understand these risks now. Better that you bring these risks up now versus trying to address them later. So when I am talking to a seller about the possibility of purchasing the property subject to the existing mortgage, because remember, purchasing it sub 2 is a possible solution, not the only solution. It's just a possible way for us to make this deal work, right? I'm not cramming it down somebody's throat. I'm not telling someone they should do this. I'm not saying, hey, what are you, stupid? Why don't you do it this way, right? That's not my strategy. Our strategy is this is a possible solution. All you do is you present all of the options. All you do is you present all of the risks. All you do is present all of the benefits. And so that's what we're doing here right now. So buyer stops making the payment, seller's got to continue making the payment. They have to step up. Now, what if the buyer doesn't maintain insurance? That's another possibility, right? That's a risk. Because if the buyer doesn't maintain insurance on the property, and in Los Angeles at the beginning of the year, we all saw what happened in Palisades and in Eaton Canyon, right? What if a house was purchased subject to then, and the buyer stopped making their insurance and their hazard insurance payments? Bad news. Bad news. That's also a risk, right? That's something that should be addressed. That's something that you should address as well. And remember, you're the buyer here. Because if you're proposing this idea to an agent or to a seller, you're going to want to cover this with them. Look, these are the risks. I'm going to do my best to mitigate the risks, but this is always a possibility. I want to be very upfront with you. Okay, buyer passes. What happens if I die, right? What happens if I pass away? Who's going to be making the payments now? All right, and we'll talk about how to mitigate that risk too. Last thing is, buyer wants to keep the loan for the life of the loan. What does that mean? So if you purchase a house subject to the existing mortgage, and there's 28 years left. Let's say the homeowner has owned the house in the last 2 years. So they bought it 2 years ago, and now they have to purchase it. They The house is worth 500. They owe 498,000. For them to sell it the traditional way, they'd have to hire an agent, put it on the market. It's going to cost them $50,000 out of pocket. Oh, and yes, they can do a short sale. We can talk about that later and address that a little bit later on. But now it's going to cost them $50,000 to sell. So what they'd rather do is explore the possible solution utilizing a subject to sale, right? So what if the buyer wants to keep the life of the loan? So that's 28 years. Let's say there's 28 years left on that 30-year loan. Another risk is the buyer. If you're the buyer, you're going to say, hey, listen, you've got a 4% interest rate. You've got a 2.5% interest rate. I am not going to sell and I'm not going to refi for the next 28 years. I'll never get that interest rate again. I want to keep that interest rate in place. I want it for the next 28 years. Well, that's also a risk to the seller, because that means that the seller and the buyer will have to be working together as a team for the next 28 years, making sure that the buyer makes those payments. That's a risk, right? You want to address that. That's the elephant in the room. That's the unicorn in the corner. That's the gorilla chewing gum. I'm running out of analogies. All right, what are the benefits to the seller? Benefits to the seller, number one, you walk away with money. You can actually walk away with money, as opposed to, you selling this and having to come out of pocket $50,000 to be able to close, using the example that I've been using throughout this entire presentation. As opposed to you having to pay $50,000, you're going to actually be able to walk away with money. And if you have an attractive interest rate in the 2s or the 3s, that enables an investor to purchase the property and cash flow, they'll give you a down payment. They'll give you even more money than you thought. So instead of you having to pay $50,000 to be able to sell this property, Mr. and Mrs. Seller, you might be able to walk away with $5,000. You might be able to walk away with $3,000, whatever it is that you negotiate. Number two, the buyer could bring the loan current. So going back to what I said at the beginning, if the house is in default, if the seller might be in foreclosure, right? The buyer wants to purchase the property, and if you're a few months behind, you've got a buyer that says, hey, I'll buy the property from you. I'm going to bring it current. I'm just going to purchase it subject to the existing mortgage. So you actually have a buyer that could bring the loan current for you utilizing this strategy. That's a benefit. That's a huge benefit. Next. 3, the buyer continues making the payments and improves the seller's payment history. All right, this is also important. If the buyer continues making those payments, it is going to reflect on the seller's credit. Excuse me. I'm on the last day of getting over a cold, I think. I'm proclaiming it. Buyer continues making payments and improves the seller's payment history. So once the buyer takes over and they continue making those payments on time, that actually helps the seller, especially if they were in default. So now think about this, right? Think of the benefits. Number one, buyer didn't have to come, and I'm using the same example that I was using the whole presentation. Buyer didn't have to pay $50,000 and dip into their 401k, dip into their savings, dip into their checking. In fact, now with our example, the seller is walking away with $5,000 from the closing table. Number two, buyer brought the loan current, right? So the buyer knew that the seller was in default, so they made the 2 or 3 months payments that they were behind. And number 3, buyer continues making the payments now, and it's helping the seller's credit history. These are all benefits that the seller is going to enjoy utilizing this possible solution, not the only solution, possible solution, right? The seller still has other options. The seller could just do a deed in lieu and just give the property back to the bank if they want. The seller could let it go into foreclosure if they want. The seller could do a short sale if they want and they don't want to come out of pocket, right? There's a lot of, the seller could pay out of pocket. These are all possible solutions. This is not the only solution. And, people who look at this, they get excited about it, and then they get frustrated when they're talking to sellers and agents, and they get shot down. They get told to go pound rocks, right? They get told to go jump off a cliff. They get told all these negative things, and they're like, this doesn't work. It doesn't work because it's a possible solution. It's not the only solution. And when presented correctly to the right person, you'll find more opportunities to be able to, work with these sellers. Why would a buyer want to do something like this? Number one, better interest rate. You're going to get a better interest rate. Way better. Especially if it's in the 5 and under range, right? Right now they're in the high 6s, maybe 7s. And again, that's if you're going to be purchasing it as an owner-occupant. If you're going to be purchasing it as an investor, they're going to be charging you a much higher interest rate. Oh, and by the way, guess what? They're going to want between 10 to 15% down minimum, right? So, no bank approval. That's the other thing. You're purchasing it directly from the seller. They're making the decision if they're going to allow you to purchase it this way, allow it to be structured this way. You don't have to go to the bank. You don't have to do a credit check. You don't have to do employment history. You don't have to. They don't have to give you an alien anal probe. They don't have to do any of that stuff. You don't need the bank anymore. Lower down payment. Again, if you're an investor, your down payments are going to be 15, maybe 20%, maybe 25, maybe 30%, depending on how many properties you have. In this case, a much lower down payment. You go back to the seller. So, which sounds better to a seller that has no equity? If the seller had to come out of pocket $50,000 on a $500,000 sale just to get rid of the house, just to be able to sell it to another buyer, they're going to have to dip into their 401k. They're going to have to dip into their savings account. They're going to have to sell some stocks in order to pay to sell the property to a buyer. They're paying a buyer to buy their house is essentially what they're doing. Which sounds better, doing it that way, or you coming to them and say, hey, I have a possible solution. I can purchase it subject to the existing mortgage. Oh, and by the way, I can give you $5,000 at the closing table, and I'll pay all the closing costs. Oh, you have an agent? I'll pay the agent's commissions too. No problem. I'll pay that. Which sounds better? Which would sound better to you, right? So lower down payment. What are the risks to the buyer? Due on sale clause. Due on sale clause, due on sale clause, due on sale clause, due on sale clause, due on sale clause. That's always a possibility. That's one of the biggest risks. Okay, that is probably the biggest risk, is the due on sale clause. All right, but we already talked about that. Anytime there is a change in title, anytime there's a change in title, with a seller transferring title to their wife, with a seller transferring title to their trust, with a seller transferring title to an LLC that they own 100%, with a seller transferring title to their children, right? Anytime there's a transfer, that due on sale clause can pop up. Again, the burden is on the owner, the homeowner, to be able to prove that they are still the owner to the lender. And there's ways to do that. Seller wants to pay off the loan. That's another risk. What if after 5 years, the seller says, you know what? It's been great. I've enjoyed this business relationship with you. You've done a great job. You've been paying the loan on time. It's improved my credit. I need to move on. I really need to move on, and I want to get this off of my credit history. My spouse is really on my case. We don't want to see it on our credit report anymore. We want to pay off the loan. That's a risk, right? That's a risk, because now you have to decide as the buyer, well, what do I do? Do I want to refinance this? Do I want to sell this? They've got a great interest rate. And all of a sudden, you're dealing with a challenge. You're dealing with the seller who wants this loan paid off. Now, again, depending on how you structure this correctly, your contracts would have stipulated, if you could keep this for the life of the loan, or if there was a balloon payment that they wanted. So that's always a risk. What if the seller changes their mind midway, right? Yes, we had a contract. I get it. You had a contract, but they changed their mind. They want to renegotiate the contract now. Just because you have a contract doesn't mean that somebody can't renegotiate or change their mind. Unfortunately, that's just a part of life. Look at marriage. It's a contract too. People change their mind all the time. All right, seller passes. So what happens when the seller passes? Well, you still continue making those mortgage payments. That's a risk. That's a possibility. That's something that could happen. You continue making the mortgage payments on behalf of the seller. You're probably going to have to coordinate things with their family. Remember, it's just the debt. Okay, the property is in your name. The property is in your name. That's very important. As the buyer, when you're purchasing a property subject to the existing mortgage, the title goes to you. The debt, the mortgage stays in the seller's name. So that's another possibility. All right, FHA and VA loans. This is also a risk. You're going to want to talk to a mentor or talk to an attorney about how to handle FHA and VA loans. There was recent lawsuits in Arizona, so you have to make sure that you consult the right people when it comes to getting advice. I'm not going to say yes or no, you should or shouldn't do this with FHA or VA loans. All I'm going to say is do your research, make sure you cross all your T's, you dot all your I's, make sure that you fully disclose everything that is going on to the seller and that everybody is on the same page. Mitigate risks by full disclosure. I just talked about that. So yeah, just make sure that everybody understands. This is a good slide presentation. If you want a slide presentation and if you want these slides, send me a message, shoot me a DM. I'll give them to you. You can use this as something that you can share with the with the seller. I mean, I tell my sellers all the time, anytime we're having this discussion about the possibility of utilizing subject to, or me purchasing a property subject to the existing mortgage, I tell them to do their own research. Go Google the pros and cons of buying a house subject or selling a house subject to. Google it and you'll see it yourself, right? There's no reason for me to have to convince them. I'll let them do their own research and they can convince themselves. But if you want a copy of these slides, you can have them. You can show them too. Hire a TC, a title company, and a closing attorney, and an escrow company. Hire people that are familiar with this stuff. Very, very important. There are some really good TC companies out there that know how to do subject to transactions. Really good ones. Really good ones. I'm not going to endorse anyone right now. I'm going to let you do your own research. And I don't have a TC company, so I couldn't recommend one that I own. But I'm just saying there are some very good transaction coordinating companies out there that can teach you how to navigate a subject to transaction. Right? They'll do it. It's going to cost a fee. Of course, everything costs a fee, but they'll do it the right way. They'll protect the seller. They'll protect you as the buyer, and they'll make sure that they document everything the way it's supposed to be, so that there isn't problems down the road. Get the right title company that knows how to do subject to mortgage. Get the right closing attorney that knows how to do it, and the right escrow company. All right, that they're well versed in it. As a reminder, if you want more information like this, you can access all of this stuff in our school community. If you go to school with a K, SKOOL.dispodragons.com, school.dispodragons.com, you can have access to this information. But here's the most important part. You're surrounded by a tribe. You're surrounded by people who want to improve their lives. They want to improve the lives of people around them. They want to improve the lives of their community. They want to improve the lives of their family. And we're all just learning, and we're all failing our way to success. All right. And this is a great way for you to meet other people. It's a great way for you to learn. Why have to make the mistakes yourselves when other people have already made those mistakes for you? Right? And you can do this by joining our community, school.dispodragons.com. It's $1. That's why it's called a dollar club. It's $1 and it's lifetime access, okay? Don't complain. $1. As a reminder, hopefully you saw value in what it is that we covered here today. Again, if you want the slides, I'll give you the slides, no problem. I mean, it's going to have my Jurassic Park theme. I didn't even talk about that today. Usually I talk about my AI slides and what I had to do for prompts and everything. But for whatever reason, I woke up with a Jurassic Park on the brain. And so that's how we came up with the Sub 2 Park theme. Make sure that you like and follow us. I've said it before, over 50% of the people that are watching our content and watching what we do, you're not subscribers. You're not followers. So please make sure that you like at this video. Make sure that you follow us on the social media platforms. If you're watching us on YouTube, click that bell icon so that way you can get the alerts every time that we go live. Typically, I try to post on all our platforms, within 5 minutes that I was going live. I forgot to do that today. But make sure that you like and follow us. We work really hard on this content and presenting it in a professional way. There's a lot of people out there. Everybody has their own flavor of who they like as their influencer who covers this material, and everybody has different personalities. And I admire a lot of them that are out there doing this, because you don't know this, but it takes a lot of effort. And so I have my own particular flavor. This is my style. This is the way I like to do it, and I like it with the slides and the presentations. It gives me a little bit of an opportunity to get creative with what I'm doing, but it's not free. It's not free. Right? There is a cost of admission, and that cost of admission is your participation and your like and your follow. That's all I ask, okay? So hopefully you saw value in this. If you need any more information on how to buy a house subject to the existing mortgage, or if you have a deal and you need it to get dispoed, hey, it's in our name. That's what we are, right? We can put it in front of the right people. Or if you need to restructure a deal, you just need a second set of eyes to take a look at it, to kind of give you advice on how you could potentially restructure it, save it, and then put it in front of the right buyers. Send me a DM, let me know. All right, have a great day, you guys. Enjoy it. We'll talk soon.